So this is a brief sort of half an hour, maybe 45 minutes presentation. So what you can see, what we're going to go through today is why build a financial model, what are the different assumptions and inputs that we have to have a look at, what are the key outcomes of a financial model, the financial statements, the key performance indicators, sources of finance, the layout of a financial model, and where to start. So why, as a startup, should you be building a financial model? Well, these are just some of the reasons, and of course, they're not all of the reasons as to why you should potentially build a financial model. So the first is to understand sustainability. So to understand the sustainability of your business. So you're starting up a business, you don't want it to last for a month, you don't want it to last for a year, you're building a business that you want to last. So is the business sustainable? That's something that a financial model should be able to tell us. The next is scalability. Is a business scalable? Can we grow the business? If that's something you want to do, and of course, many people come to me and they say, but Matthew, I just want to become self-employed. I just want to become a consultant by myself. I don't necessarily want to go and employ other people. That's absolutely fine. However, if you do want to build a business that you want to be able to grow and raise capital, you want to be able to assess the scalability of your business. The next reason why you might build a financial model is to obtain funding. Of course, you might come to a stage where you're growing your business that you can't fund it completely off of your own equity, and you might need debt funding or a bank facility. Of course, one of the things you want to do is avoid going bankrupt. Now, many small businesses actually go bankrupt, not because they aren't doing well, but because they're actually doing too well and they grow too quickly. They grow too quickly, and what happens is the revenue doesn't always materialize into cash in their bank account. And this is something I speak about all the time, that I like cash flow based modeling. I'm not an accountant by background. I don't necessarily understand accounting. And accounting to me doesn't show cash in your bank account always. You can actually have a very good revenue figure, but that doesn't necessarily mean that you've got that cash available to pay expenses. So I like cash flow based modeling. That to me is more real as an entrepreneur. Of course, the next element is funding. Understand how much and what sort of funding you require. So that's a case of, obviously, when you're starting out, you might just need short-term funding, like a working capital facility. But as you grow, you might need longer-term funding. Maybe you want to build a factory. Well, building a factory takes a long time. You don't want funding just for 1 or 2 months. If you think of a credit card, you want funding that you're going to be able to draw down a facility over a 2-year period while you build a factory, and then repay the loan once that factory starts operating and generating profits. Inform. Financial model both informs the business owner and shareholders and even banks and lenders how a business is doing and what a business's plans are for the future. Scenarios, running scenario analysis. So now this is exceptionally important. So at the moment, we're living in the time of coronavirus, and in fact, we've closed down a lot of construction that is happening on various projects around the world. So one of the scenarios that thankfully projects ran was, can projects continue if construction is delayed by 4 or 5 months? And that's a scenario that we're seeing play out at the moment. So obviously, running scenarios is incredibly important. And for small business as well, what if your business does very well? What sort of funding will you need then? What if your business doesn't do well for a month? Will you need some working capital to help you tide over? And finally, valuations. So many people want to value their businesses and understand, is their business worthwhile, worth a lot of money? Can it actually be sold? And a financial model actually helps you come to what the value of your business is. So why do you want to build a financial model? Just to recap, you want to validate your business idea. Entrepreneurs have business ideas, and entrepreneurs are naturally very optimistic. They're optimistic people, and they say, this is definitely going to work. I've got a business idea. It's a great business idea. It's going to work. I'm going for it. But a financial model tells you, will that business actually work in practice? Let's have a look at the numbers. Are you going to be generating enough revenue to cover your expenses? You want that office space? Are you going to be generating enough to pay for the office space and for you to live every month? If you're going to be growing, how many staff members do you need, and can you afford their salaries? When will you run out of cash? And as I said in the previous slide, many businesses actually run out of cash when they grow too quickly. They're selling a lot of their products, and their revenue looks great. But in terms of their payment terms with their clients, maybe their clients are only paying them 30 or 60 days later. and they have to pay ongoing expenses and cost of goods sold as they are manufacturing these goods. In such a scenario, your expenses would actually be incurred before your profit is realized in terms of cash in your bank account. You could actually run out of money. In such a case, working capital would be something that would be needed, and a financial model is something that will show us how much working capital we need and when exactly we need it. To pitch to investors. So financial models are great tools to go and pitch to an investor to say, invest in my business. I've given it a lot of thought. This is the financial model. This is how much money I need from you and what your return will be. To test assumptions as well. So financial models are great to test assumptions. Often entrepreneurs will put their assumptions in the financial model and realize, oh, hang on a second, this business actually isn't as sustainable or isn't as scalable as I thought it was. It also helps to clarify the business model. So, many entrepreneurs, they come out with a business plan. But what I don't often see in the business plan is an attached financial model. So the business plan is your strategy. Your business financial model is how you're going to achieve that financially, practically. How you're going to achieve it. And obviously to track performance. I'm a big advocate that financial models should be continuously updated on a monthly basis. It really helps you say, this is what I forecast. Are we matching the forecast? Do I need to revisit my assumptions? Is the business growing in the way that I thought it was going to grow? So one of the things to remember when it comes to financial models is a financial model is never 100% accurate or complete. If your financial model is complete, it means you shouldn't be being an entrepreneur. It means you should be playing the lottery, because it means you can actually predict the future. Okay, a financial model is a forecast, and it's your best estimate of what the forecast will be. And obviously, that's why you run scenarios, because you're not 100% sure of that forecast. So you want to see upside and downside scenarios. It's never going to be accurate. That said, your logic of your financial model and the integrity and the workings of your financial model should be accurate enough to give you an idea of how your business will perform. And a good financial model grows with and supports the business. It's something that you can take to investors and lenders. It's something that you can use to raise capital, something that you can use to identify issues in your business. So a financial model is really a great tool that you should use to grow your business. So what are some of the things you want to see in a financial model? Well, this is an example of a financial model, and we can see this is for perhaps software as a service company, a company that offers subscriptions online. So as we can see, it attracts new customers, and it shows us a metric on new customers growing or decreasing in the latest month. Reactivated customers, that's perhaps customers that dropped off that have now signed on again. New subscriptions. Active subscriptions, people who are upgrading or downgrading. Churned, so this is very key as well. How many customers are we losing on a monthly basis? People who might be redeeming coupons, refunds that the business has to give, and of course, you want to be having a look at, if you're a software as a service business, what's quite key for those businesses is that annuity income. So monthly recurring revenue, net revenue, fees, other revenue, average revenue per user, very key. Your monthly recurring revenue growth rate. And of course, you want to have a look at your cost of customer acquisition. So, software as a service, and often these new tech businesses, they don't have traditional expenses such as cost of goods sold, but they do have other expenses, especially when it comes to online marketing, server costs, support costs, infrastructure costs. So with every business, we have different types of revenues and different types of expenses, and a financial model helps us to conceptualize these. A lot of entrepreneurs come to me and they say, Matthew, I don't need to build a financial model from scratch. I've downloaded this template online. It's great. It's easy to use. I put in my assumptions, gives me an output. I don't need to build a financial model or even really understand it. Now, financial model templates are great. I use them as well. But I have to warn you, though, that with every financial model template that's built by somebody else, you need to make sure that you understand it. Firstly, that it's applicable to your business, because many financial model templates aren't and require significant customization. Secondly, that there aren't any errors in it. You can't be guaranteed just because it's a template available online that there aren't any errors in it. And thirdly, that you really understand that template, even if it is applicable to your business, because often these templates have a lot of hidden functionality and features that we aren't always aware of. So templates can be used, just be careful, change them to suit your business. They certainly require an understanding of the template. Also remember that each business and each country is unique. Each country will have different tax rates, different laws around dividends and equity, and how tax and how assets can be depreciated over time. So there's a lot of things to take into account here. Rather, create a very simple model that's maybe not as complex, but from scratch. Something that you understand and that shows how revenue is built up. What are the building blocks of your revenue? How your expenses are built up? What does your cash flow waterfall look like? And then, of course, you can adopt ideas from other financial models. So here's an example of a template where one can download. This is a Google Sheets template. It has all the different roles over here that you can go and change. You can put in a salary, benefit, fringe benefits. Even over here, we can see that the salary is in dollars. So if your currency is in dollars, you would have to go and change that. So just these are the things to kind of think about when you are working with financial model templates. Now, as I said before, I like cash flow-based models. So accounting may show a profit, but that profit isn't actually being reflected in your bank accounts, right? Your bank balance shows something else. So I'm in my background, and I like cash flow-based modeling because for me, cash flow-based modeling is the most realistic. So cash flow-based modeling actually says, hang on a second, revenue might be coming in January, but the cash only comes in February or March. So I need to reflect when cash comes into my business because I need cash to be able to service debt, to pay expenses. I can't go and tell my staff, well, yeah, I'm paying your expenses now, but I'm paying your salary now, but it'll only reflect in your bank account in 2 months' time. It doesn't work like that. So cash flow modeling, exceptionally important, especially for startups. Assumptions. Now, when it comes to assumptions, we need to be obviously exceptionally careful. So assumptions, we need to put them into our financial model. How many staff members will we have? What do we expect sales to be? What do we expect our expenses to be? Are we going to be renting office space? What are our online marketing costs? How much will we spend on marketing? How do we expect our business to grow? Will salaries be going up by CPI? All of these are assumptions that are very key to a financial model. A well-built financial model will have all of your assumptions on a separate worksheet. So a worksheet just for all of your different assumptions. And it'll be split up to the various types of assumptions. So your revenue assumptions, your expense assumptions, growth assumptions, perhaps tax and macroeconomic assumptions. If you're going to be importing goods from overseas, what are the exchange rate assumptions that you're going to be using? So those are all the different assumptions in your workbook that you need to think very carefully about. So some of the real difficulty for entrepreneurs is, so what are these assumptions? Yes, I know I need all these assumptions, but what should the numbers actually be? How do you forecast sales? What is the market size of my sector? How much should I spend on marketing? What business model is best? What should my expenses be? These are very difficult questions. And this is why being an entrepreneur takes a lot of thought. When you're setting up a business, it takes a lot of thought. You need to do a lot of investigation. You need to understand what is the market like in which you're playing. What does a small business need to spend on online marketing to really get traction? What are my expenses? You need to do a lot of research to actually show that you've given a lot of thought to the business that you want to start up so that you can get these assumptions as accurate as possible. Obviously, when it comes to assumptions, it's very key to understand your market share and revenue. So the business model will feed the financial model here. So one of the ways in which you can do it is do a top-down approach, where you start with your overall market size in your country or wherever you plan to be operating. You identify your segment of the market, and then you identify, so how much of that market segment can you capture? And then you calculate a total potential revenue figure, and that will be a driver of your financial model. Again, when it comes to assumptions, as I said, create an assumption page. You need to clearly define what all of your assumptions are, and all calculations in your model should be linked back to the assumptions. You need to be as transparent as possible. This model might be going to investors, it might be going to banks, lenders. You need to allow a user who doesn't understand or know your business to be able to work through and understand the model. And often even comments in your financial model help a lot here. Aim for simplicity and ease of understanding. I've seen exceptionally complex financial models for the most simple of businesses. Why? It's not necessary. Rather have a simple model that accurately reflects your business. You need to be inputting overheads as detailed and as granular as possible. Really try and get granular with your expenses so that you can actually start seeing how each individual expense is driving the profitability of your business. Don't forget about macroeconomic assumptions. Obtain forecasts wherever possible. So remember the difference between real and nominal costs here as well. You need to be taking into account inflation in your models, right? So expenses as we know, if somebody hired you and said, I'm going to be paying you X amount with no salary increase for the next 10 years, you probably wouldn't accept that. You want an increase at least in line with inflation, and likewise with rent and all of your other expenses. So we need to be cognizant of that when we build our financial models and take all of that into account as well. When it comes to the different inputs for revenues, we need to be looking at a sales forecast. We need to be looking at pricing. How much are we pricing our product at? We need to have a look at volumes of our product. Are we going to be issuing refunds? And of course, how does both the price and volume grow over time? So pricing, maybe you want to keep it fairly low growth over the first few years while your business grows. Maybe it will be growing in line with CPI. Volume growth, obviously that will grow as you attract more and more customers. These are the key inputs to your revenue lines. Costs of goods sold. Now, cost of goods sold is often misunderstood when it comes to financial modeling. These are the costs that make the products you're selling. Why I say it's so misunderstood is often I get tech companies approach me and say, I don't have any cost of goods sold. I've created online training and I've done it once, and now I just sell, and I've got no cost of goods sold. It's not entirely true, so just be careful with that. Cost of goods sold may differ based on the type of offering you sell. So for a company that sells a tangible product, it's quite easy to calculate what the cost of goods sold is, the cost of materials used in creating the good. For a company that sells consultancy hours, obviously that's the cost of personnel. For software as a service business, cost of goods sold is usually different. It's usually things such as hosting costs, customer support, onboarding costs, online payment costs. And of course, we must always remember the cost of customer acquisition, very key metric when it comes to tech businesses. Typical operating expenses for startups include events. This would go under your marketing budget, traveling, legal costs. Also for that, you should spend a little bit on legal to make sure that all of your agreements and documents are in place. Online marketing, exceptionally important in today's world. Payroll costs of employees. So, that would be something that is not part of cost of goods sold. Perhaps we've got a support staff. Obviously, you might also need to pay for accounting, rent if you're renting offices, utilities, insurance, prototyping, patent costs, IT costs, office supplies, promotional materials. All of these things need to go into your financial model. And don't forget, as I said, that these costs may increase with CPI over time. One of the things you might want to look at as your business grows is investments in assets. So typical capital expenditures depend on the type of business and industry. For startups, it is quite common to invest in computers, software, office equipment, and machinery. And obviously, sometimes you need equipment to build or to test your products as well. So those also need to be taken into account when you build your financial model. And you should be very upfront with what the startup costs to start up your business. The last thing you want to do is raise capital for your business and then realize afterwards, geez, you've raised capital, but actually your startup expenses were much more than what you originally envisaged. Now you've got to go and raise capital again before your business has even started up. That's not a good scenario to be in. As your business grows, you might want to take into account financing. So financing streams such as equity, loans, grants, or subsidies are very good forms of financing for startups. You want to have a look at what is the impact of the financing that we require and what sort of financing do we require. So there's lots of different types of funding, all have different repayment terms, different costs that you want to be able to take into account in your financial model. When a model includes the possibility to input loans, it needs to account for the loan repayments and obviously interest repayments as well. So interest rates need to be one of the assumptions that you look at. And these will have an impact on cash flow. So again, cash flow-based models, exceptionally important. So what are some of the sources of financing you typically see in startups? Equity, that's money that you put in. Debt, very rarely do you see that in a startup. Usually, if they get any sort of external money, it'll be in the form of venture capital. Crowdfunding, exceptionally important, and we're seeing a lot of that these days. And subsidies, grants, often overlooked, but often a great source of funding for startups. Now, this is a question that's more applicable when a startup becomes more of a mature business, and that's a question of, is debt cheaper than equity? So, we must remember that interest is actually a tax-deductible expense. Lenders are less tolerant of risk, though, so they expect monthly repayments, whereas equity, are willing to accept more risk. Debt does require consistent payments, and not all sources of finance are always available to companies, so especially a startup, debt might not be available. That said, for established companies, debt is typically a cheaper form of funding than equity, but obviously it comes with a lot more rules and a lot more stringent. So that's sometimes the case, but not always the case. And your aim as a startup is to reduce what's called your WACC, which is your weighted average cost of capital. Now, I'm not going to spend too much time on this slide because I come back to it when we get into financing for SMEs. Now, I love this slide. This is an indication of what financing might look like over time for a business. So you can see from a startup where we have a look at self-financing. Prototype, we might go to angel investors. As we're launching, we might go to venture capital. As we're going through the growth curve, we would have a look at traditional funding. And as our business really grows and matures, we might look at a listing, which obviously only comes much later on in time. And then numerous different forms of this financing cycle. We can see here, this is a great one as well, which shows you crowdfunding, business angels, and venture capital as you increase over the company maturity. Grants, as I said, don't forget about grants. And I'm going to pause on this slide as well for a moment. This is in much more detail, where we go from initial concepts, research grants, personal savings, right through to seed and startup, where we have a look at angel investing in early stage venture capital, expansion, corporate venture capital. Late stage, we'd have a look at more sophisticated forms of financing, such as senior debt, mezzanine financing, private equity, cash flow and asset-based financing, and then much later on IPOs. Obviously, in the seed and startup phase, you mustn't forget about crowdfunding and microfinancing as well. And a lot of these facilities are available, especially for these early stage startups. Working capital is extremely important. Now, I've mentioned working capital before. So for startups, it's really a measure of a company's efficiency and its short-term financial health. Lack of working capital can lead to bankruptcy, and that's why working capital is an exceptionally important facility for startups to have when they are looking at being able to fund expenses over the short term. In cash flow-based models, again, this is why I love cash flow-based models. A cash flow-based model will show you the need for working capital. I'm just going to have a look at some of the key outcomes of a financial model. And as you may know, you have your financial statement. So your income statement, your balance sheet, and your cash flow statement. But for me, what's far more important than all these for a startup is a cash flow, simple cash flow model to show when is cash coming in and when is cash going out of the business. This, to me, is the output of a financial model that can even come at a later stage. It is useful, though, so we have a look at our profit and loss statement, which calculates whether you're profitable or not over time. Again, it's not the same as having cash. Small businesses fail because they don't have cash. So that's something exceptionally important to have a look at. The P&L statement will show several crucial performance metrics, such as your gross margin, your EBITDA, or earnings before interest, tax, depreciation, and amortization, and your net margin as well. And it can be used for comparing different time periods, your budget versus your actual performance. So it is useful. Just looking at breaking down EBITDA for a second is a very key metric for startups. It's important for investors, provides them insights into the operational performance of a company, and allows them to compare efficiency of a company when comparing a startup versus another company. It eliminates any effects of financing. So it eliminates any effects of interest, and taxes, and depreciation. So it's quite useful from that perspective. And I see what's quite funny on the slide over here. First time I've noticed that actually the letters in the wording don't line up. So this is earnings before interest, taxes, depreciation, amortization. They've just mixed those two words up there. Very important for a startup to have a look at some of these key metrics that they can be tracking over time. Gross margin takes into account your revenue and your cost of sales. Your net margin then takes into account, after your cost of sales, your operating expenses, tax, interest, etc. So it's your net margin. So these are some key metrics to have a look at to evaluate your business over time. Your balance sheet, I'm not going to spend too much time on this slide. Your balance sheet is an overview of everything the company owns, which are its assets, and everything it owes, which are its liabilities. And obviously the difference between its assets and liabilities is the equity. So you can see there, your assets equals your liability plus your equity. And if you move liabilities over to the other side of it, equals your equity equals your assets minus your liabilities. And again, I'll get into more of this in another webinar, which is focusing on the financial outputs of the financial models, your financial statements and what they mean. Obviously, this webinar focused on just financial modeling for startups, and we're going to keep it relatively short. Cash flow statement shows all cash going in and out of a company over a specific period of time. Now, cash flow waterfall is what I prefer to look at. And I'm going to get into that in my next webinar, which looks at cash flow waterfall modeling. For me, so important when it comes to businesses, because as I said before, cash flow-based modeling shows you how much cash is in your business. And I sound like a broken record on this, but I can't harp on this enough. Small businesses fail when they grow too fast and run out of cash. It's as simple as that. Now, obviously, what's quite nice if you do lay out your financial model in a nice output like this, you can have a look at your gross margins, when you expect to break even, your compound annual growth rate over time, and you can see here you've got your EBITDA sales over time as well. It's quite nice to see track business growth using your financial model. And this is why I say financial models should be continuously updated over time. I'm going to speak about some KPIs. I've mentioned some of them before. So revenue per account or user, customer acquisition costs, LTV to customer acquisition costs is the average revenue of a single customer predicted to generate over the lifetime of their account to the customer acquisition cost. That's quite a nice ratio for tech companies. And monthly recurring revenue growth rate, great for companies with annuity revenue. I'm not going to spend too much time on this slide either. Obviously, KPIs for different businesses may vary. So those might not be applicable for your business or the startup that you're looking at starting up. So you need to give some thought as to what defines the success of your business. Those are the metrics that you need to take into account. And really, how will your business grow over time? So just to wrap up, how do we build a financial model? We make sure we have all the inputs. We make sure we understand the general financial model structure, and there are numerous examples online. We design and build the model. We calculate the key performance indicators and outputs. We check it. Check your financial model. And we keep it alive. Right? Financial model is something that needs to grow with the business and help support the business over time.